Now starting. All attendees are in listen-only mode.
Good day, everybody, and welcome to our webinar today, hosted by Merchant Tech. My name is Dineo, and before I hand over to Brian, who will be taking you through their mid and small cap research review for 2020, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It'll be the hand icon next to your name. All right, I see a few hands. Okay, as always, Brian will go through the presentation. You're more than welcome to send your questions through, but Brian will be addressing them right at the end. And without further delay, I'm going to hand over to Brian. Brian, good morning.
Morning, and thanks very much, Dineo, for hosting us once again. So good afternoon, ladies and gentlemen, and welcome to another webinar hosted by Merchant Tech Research and Standard Bank Online Broking. We specialize in producing research on the mid and small cap sector, and we've done so for the last 20 years or so. And just a reminder that through our association with Standard Bank Online Broking, you can access all our research reports on their website, where you'll find detailed analysis and coverage of all the stocks mentioned today, as well as a copy of this recording and previous webinars that we've done. My name is Brian Rainier, and I'm a Director of Research and head that up for Merchant Tech. So thank you once again for your attendance today, and I really hope that we are as good or as lucky to once again give you some direction with our top picks in today's discussion. So we're going to revisit the effects of the pandemic and the lockdown on the local small cap companies and see what that has done for their prospects and valuations. We've had a few of the companies actually reporting results, and although that only really took a couple of months into account, it has given us some indication from management as to what happened at the worst of the lockdown and also prospects for where they see things today. And we'll have a look at how the share prices have reacted from there and what opportunities we continue to see in the market. So in terms of a high-level overview, the global picture remains still somewhat bleak to uncertain, with most of the globe forecast by the IMF to show still some significant declines in GDP over the next year, and with very few exceptions shown in this global view. So the red really indicates everyone who is forecast to have less than 3%, more than 3% contraction, and green is are those that are going to show some positive aspects of GDP growth, and the other colors somewhere in between. Interesting to see that Africa looks like it will be somewhere between -3 and +3, and maybe even a little bit better in terms of some of the GDP growth. And that may be as a result of either coming off a very low base or the effects of the pandemic not really being seen in those areas of the globe. If we have a look a little bit more specifically at the OECD projections, then we see that Europe is forecast quite strongly down, 12% negative GDP. And then we see a cluster of the United States, South Africa, and basically in aggregate the world showing forecasts of -8% GDP over the next year, with China showing somewhat more optimistic prognosis in relative terms at -4%. So the biggest uncertainty out there amongst economists at the moment is really whether there will be a double dip caused by reinfection and whether this will happen or not. The projections showing a return to 2019 activity by the end of 2021 if we don't double it. And then really huge question marks as to a recovery and as to the extent as to when that will happen if we do get a reinfection with the double hit scenario. The discussion amongst local economists around the prospects for the South African economy unfortunately remain very pessimistic in spite of the recent IMF soft loan of some 70 billion rand and the government stimulus packages alone. But there's increasing nervousness around our national debt if that continues to expand, projected 80% of GDP in 2021. And the real doomsayers are projecting a full IMF bailout as being inevitable in the next couple of years. The only real silver lining of that I could see would that, and again there is quite a lot of commentary on this, is that a strict reinforcement of economic policy could force either a regime change and or a fiscal and policy discipline, which is really required to bring South African economy back under control to more sustainable levels in terms of spend. In the meantime, our discussions with management are really about heads down, focus on what is there in the economy, what they have to work with. And the talk is really about a rebased 80% economy. We're looking, a bit more than that 8% decrease in GDP that we spoke of, outlining it more of a 20% decline in overall activity in aggregate. Most of management's attention has understandably remained on cash conservation and cash generation, again with little regard to accounting profits at this stage. Focus continues to be on severe cost cutting, which we have seen as being both quick and deep. Unfortunately, with Labour bearing the brunt of this, with some quoted 3 million jobs lost to date, probably more in the pipeline. But management has continued with the renegotiations, cash payment holidays with suppliers in most cases. This being property leases, and we see the property industry continues to bear a huge brunt and uncertainty in that respect. Most leadership teams, in spite of reporting on their results for the first quarter, are very hesitant to give a forecast for the next year. And massive uncertainty still prevails for the next 12 to 18 months. So we reiterate the three things that continue to impact on company survivals and see this evidence in the recent reporting. And that will be the effect of the lockdown on top line, i.e. revenue, and that's typically a factor of the sensitivity of the business and the length of the lockdown in their particular industry. For example, hospitality, hotels, restaurants will continue to suffer in particular. The financial and operating leverage in the business. By that I mean how good, what buffer there was in their margin and how cash generative businesses are relative to the debt that they may have taken in. And then finally, the actual ability of the company to weather the storm based on their access to either cash or debt even in these times. So given the above, and revisiting our more specific assumptions in terms of our universe of coverage, and based on the recent results, we see that most businesses that did indeed get back to more or less full operation in July. But it looks like that at least 3 months revenue will be lost in February, and that will typically translate to at least 20% revenue compared to last year. With that, margins are similarly being affected, approximately 20% lower as well. It's been very difficult to cut fixed overhead very quickly, things like leases. It's also been quite difficult to cut the variable costs. So salaries, whilst you can retrench, these come with significant costs and time as we have to right size the workforce. To further cut cost management have pretty much all across the board led by instituting salary cuts for themselves and across the workforce. Introduce things like unpaid leave, rental discounted that I discussed about, and the enforced holidays leave as well. I think one of the big things that is still very uncertain out there is what is going to be the effect of the consumer base. You know, if you're putting 3 million people out of employment, what is the impact going to be on consumer spend within their families if they're the breadwinners, etc. And recent early figures demonstrate there's been a massive knock-on in terms of particularly the retail sector. We further expect to see continued staff and lockdown level disruptions. Hopefully we won't go back to level 4 or 5, but we do have anecdotal evidence of factories having to be shut down as infection happen. And this is very disruptive in terms of breaking the production cycle. And that's going to continue to happen, we believe, through the next year. That being said, we do expect to see some recovery across the board. And towards the end of 2021, we see this to be around about 90% of what was reported pre-COVID, i.e. in 2019. And our forecast is probably optimistic in saying we expect some kind of a normalized performance returning towards the end of 22 and into 2023. On that basis, we've updated our matrix of winners versus losers and those that may get some benefit. So we've moved manufacturing and construction up into somewhat losers quadrant alongside banks and insurance. Those exposed to debt and insurance claims look like they may still take some pain. Plus, we continue to see significant impact across the board in those industries still affected directly by lockdown, i.e. in general, retail, wholesale businesses, leisure and gaming, hospitality, property, logistics to a certain extent, and then businesses facing the workforce in terms of labour broking, recruitment, etc. Those that continue to do reasonably well is anyone who's got their business very well organised around online, so online retail, training, broking, financial services, etc. And then the businesses of ICT and connectivity still remain. People still need to invest in infrastructure. You obviously see food producers producing staples and doing relatively well. People still need to consume. And businesses in assured annuity services like security and online subscriptions and business services. What's interesting, even amongst the doom and gloom of the economists and the GDP forecast, is what we're seeing happening in the market. So the Johannesburg Stock Exchange, and this reflects quite a lot of what's happening in overseas markets. We see almost a full recovery to pre-COVID levels. This very often driven though by the very top stocks in the index, either foreign currency earners or in the case of US stocks, the top IT businesses, the Apples, Amazons, Googles of this world, etc. And that's unfortunately not reflected in the small cap stocks. So you can see, whilst there's been a recovery since we last spoke to you, and since the real negative downturn in the market of 35%, that is now up to a 25% loss. And we still continue to be significant losses across the sector. We can see that reflected in terms of the price changes for our full universe year to date. There's been some activity positive though, a major outperformer being Quantum Foods, which has been the subject really of a major shareholder activity pending the bidding contest. Our previous picks are highlighted in green. The better news on the next slide in respect of that, as we see the performance since our last webinar on the 25th of May, where we've seen some significant outperformance from our top picks, significant gains from Invicta, Quantum Foods, EOH, and Alviva, and still to perform, and we'll get to that in a while. And disappointing in that they've continued to slide were Adapt IT and OneLogix. So we saw a performance of around about 180% over the quarter overall, with an aggregate of 33% gain per stock that we recommended in our top picks. So moving on to our top picks for the next quarter, I just wanted to very quickly recap on how we approach valuation. We look at four things. We look at the price earnings ratio. That's typically been historically the best gauge of short-term price direction. The last 20 years that we've used this methodology. And while it continues to indicate very short-term price prospect, it's exceptionally difficult at the moment for us, given the forecast risk on the earnings and the E in the PE ratio. And in terms of establishing a relative comparative basis, there's also very little information out there for us to have a reliable forward earnings forecast period. So there is a caveat to that we are basing our forward PE very much on our own forecast. As always, though, we also look to the medium and longer term, and we look to a discounted cash flow valuation, which looks at 3 years of forecasts, and then a terminal growth rate, typically estimated at the estimated inflation rate, which we estimate will probably be higher at the 6% level at that stage. This is where one could look to see the real value with the longer term view being unlocked, particularly amongst these small cap stocks. We've also looked in this analysis at the price to book. More importantly, given the potential for write-downs and impairments at the time, at the price to tangible NAV book value. And then this ratio can be compared to historical averages to understand either a reversion to normalized means. But we do need to be very wary of applying historical accounting methods to the asset, particularly if we're going to expect to see write-downs or losses in the current environment. So again, one needs to be wary of using a standard price to book ratio. And then finally, we look at the financial health of the business in terms of the immediate cash flow constraints that the business may face. And here we examine the ability of the business to generate free cash, particularly reflected in the EBITDA, earnings before interest and tax, depreciation and amortization. We compare that to the actual interest bill. We call that the interest cover ratio. So in this first slide, we've got the potential upside based on the short-term price earnings valuation on the y-axis versus that measure of risk that I spoke about as reflected in the interest cover that I defined. And in this first graph, you can see those stocks of particular interest with very high potential price gain on a PE basis. Here we say greater than 30%. And a good interest cover typically greater than 2. Include Adapt IT and EOH once more, and that goes disqualified because of its low interest coverage ratio. And when we adjust the scales, we'll pick up the bunch that you can see towards the lower end of the scale. And there we see still significant potential with New World, OneLogix, Westpol, which is the new one, popping up on our radar, and Alviva. However, we do see for a lot of the stocks in the market right now as being largely correctly priced, as the balance of that universe on a short-term PE basis, we see the price upside downside is with that band of 15% plus minus. And typically we would say the market's probably got it right at this point in time. Turning to the longer term discounted cash flow valuation, our analysis shows that this universe of stocks has been very oversold at this point in time. And we see huge potential re-rating for the group, as we see an average price appreciation potential of 50% across the board. In terms of individual stocks, we once again see value in Alviva, Westpol, OneLogix, and Adapt IT. And then EOH, MetAir, sorry, I'm one slide out. EOH, MetAir, Simbi, Invicta, Unani, and Datatech, all above 30%. Our next graph looks at the price to tangible NAV, or book ratio. And there we're interested in stocks that trade at a ratio below 1 to 1. The lower the ratio, the more undervalued the stock. Important to note here, as I said earlier on, NAV is largely historical, and that many of these companies will be reporting losses and impairments to their balance sheet, so these ratios may increase, and the potential value gap narrow. We see many of the same names here again. Do take note that the two technology stocks that we've been putting forward, EOH and ADI, which scored highly on the other metrics, are punished here with negative price to tangible NAV ratio, and to the high carrying value of the intangible asset, which is mainly goodwill, which is being acquired on acquisition. So this analysis again gives support to value yet to be unlocked in these assets, and shows where value could come from and could come through in a more normalized economic situation. On the basis of the above, we did a ranking over all the metrics, and we produced a weighted list of where we would see the greatest opportunities in the following stocks. And we'll give a brief overview of these, and they are in order: Adapt IT comes out on top, followed by EOH and Alviva, all three IT stocks, and then Westpol, OneLogix, and New World. Adapt IT is a niche enterprise software provider, approximately 60% of its revenue being annuity-based, so annuity-based in good times. While the business is well diversified, it is facing some significant challenges in that the particular markets that they operate in include those that are quite badly hit at the moment, which are the hospitality industry, so hotels, retail stores, everyone that uses the point of sale software and system. Oil and gas, which is down as a result of the lower oil price, and then the education sectors, which have obviously all continued to perform, but which are under state of a fair amount of chaos, given the lockdown. So furthermore, the group had taken on some significant debt to fund acquisitions just prior to the global pandemic, And that does present additional risk to earnings, and we believe that's contributing partially to the current low rating. Unfortunately, a lower share price, lower rating means that they can't pursue new acquisitions in the current market. And historically, in the last 4 to 5 years, that's actually been a fairly significant contributor to growth. But unfortunately, again, the lower rating doesn't mean you can get back onto your acquisition path, leading to higher growth, which leads to typically higher rating. That being said, though, given the assumptions we've put into our models, etc., we believe that the market may have overreacted, and we believe that businesses in IT will fare better in the medium term, given that IT spend is largely non-discretionary, and we do see medium-term potential. That's it. The results are to be released within the next few weeks, and we'll see how right or wrong we were in terms of our assumptions. Our next company is EOH, and they're one of South Africa's largest providers of ICT and software services, and have not only had to recover from COVID-19 implications, but they also are still recovering from corruption investigations and major restructuring of the group, which was to correct an overly ambitious acquisition strategy that they embarked on over the last decade. Management is making good progress, has sold over 41 entities over the course of the last year, paid down a scheduled 1.6 billion in debt, and according to the latest market update, they're well on track in their recovery. Share price has increased more than 45% since our previous webinar following 2 positive market updates. It is one of our higher risk stocks, but we believe that once it's got its house in order and it's demonstrated a couple more reporting periods of positive growth and restructuring, then it will re-rate quite strongly. And we expect it to do very well on that basis. So once again, we have Alviva as one of our top picks. They're also an IT company, one of South Africa's largest distributors of IT equipment, as well as a fairly large provider of software and services. I mentioned we continue to see maintained demand for IT equipment and increases of all areas of IT, particularly supporting remote access over the short to medium term. Demand for IT security is also increasing as more and more businesses are operating online. And even though our forecasts see earnings declining significantly in 2020, we expect to see a strong recovery in 2021. And at these prices, Alviva continues to look attractive. An interesting company is Westcoal, which has popped up on our radar. They're a coal-focused junior mining company, which includes mining, processing, and trading of coal and coal-related products. The group has got long-term coal supply agreements in place with Eskom and expanding their mining operations to ensure sustainable coal production. They are suitable for investors with a higher risk appetite and a longer investment horizon, as the group performance will rely quite heavily on the mining segment, as the trading division is set to struggle amidst increasing coal demand and the oversupply in the local market. They also had a poor results reporting period recently, and management's update subsequent to that is that things are on track for a much stronger 2021 year, and therefore we expect to see a re-rating on the back of that. OneLogix has also come up on our metrics with a healthy earnings to interest cover ratio of more than 5 times and a very low price to book ratio. OneLogix is very well positioned in South Africa, covering cross-border transport, sectors of vehicle storage facilities near the Durban port, and are very much a niche abnormal transport services business. We're a mid-tier player in the space, and we believe there is significant value in the shares once the economy starts to pick up and logistics start flowing as they have to once again. Our final pick is one of the retail businesses, New World. They import and sell smart home appliances, electrical appliances, electronics, and smart devices in South Africa and abroad. And although retail has been hammered and prospects are still fairly constrained, our forecasts are conservative, and we believe that both our PE and DCF valuation point to value in the medium term. And what's further attractive about New World is that they're demonstrating a huge discount to NAV, which we believe must narrow as things improve in the economy. So that brings us to the formal end of my presentation. I'd just like to remind you that all our research, including this presentation, is available on the website for Standard Bank clients. And please look out for our detailed reports as we release these, as companies provide their latest results, many of which are still coming out in the next month or so. And from those, we'll get a better sense from management and we'll view the effect of COVID-19 and their prospects. Do also remember that our forecasts are hugely subjective, prone to misinterpretation, etc., and our recommendations do not constitute advice on an individual basis. And please refer to our published disclaimer in this respect on our website. And I am now available to take your questions. So, yeah, we have a few questions. Could we give some more input on Met Air? Unfortunately, Meta is in a closed period at the moment, and we're about to see their results coming out in the next week or so. So please look out for that. Once the results have been published, and we put out a formal note on it. Questions on Avenge, unfortunately, are not a company that we do cover. The question, what are the debt levels in ADI? Off the bat, without the figures on hand, they are fairly significant in that they have a debt of about 500 million on the balance sheet, which is significant compared to their market cap of around about 250 million. But when I last looked, their interest cover was around about 3 times, which we felt was reasonable. A rights issue, I think a rights issue at this share price would be very difficult for management to contemplate. And it appears that the businesses are reasonably cash generative. They always have been in the past. We just need to really see what the effect has been on those hospitality industries, and how significant the drop-off in those businesses have been relative to the other industries that they have. It's a big question with ADI. ADI are a yeah, we would expect their June reporting or close off. So they typically have 3 months in which to bring their results out. In answer to a question, when will ADI report? Right now, the JSE has given some dispensation for companies to also extend their reporting times by, I think it's up to about a month or so. And we don't know when they'll bring that back. Question, how much revenue do we think has been lost in ADI due to COVID? Different hospitality education sector exposure. So, as I said, they are relatively diversified across 5 industries. We have seen, I expect to see pain across all of those, but mostly, as you say, hospitality education. And I would expect to see 30 to 40% revenue lost across those. But in aggregate, across the group, giving us maybe 20% revenue top line across the group for this for the year. Okay, I don't see any more questions coming through. So, unless there are any more questions, I think we're going to call that a couple more coming through now. The question, do we consider a future closure of Eskom's power stations or Westcoal? Look, I guess one would be taking a very, very long-term view on the closure of those particular power stations. But my understanding, and I need to go and check on it, I think the power stations with which Westcoal has local supply, and it's very local. They don't transport very far at all. They're in fact entering into new agreements with Eskom for power stations. Arnott is the latest one that they are gearing up to supply. So I think we've seen that. Whatever your view is, unfortunately, coal-fired power is still on the agenda for South Africa for at least the next 10 years, in my opinion. So someone's asking me, and they're saying, when I talk about long term, what do I mean? I.e., for a share price doubling. I would call short term 6 to 12 months, medium term up to 2 years, and long term, I would say 3 years and longer would be my expectation. Okay, just waiting for a few more questions to come through. Is it worthwhile to watch till the stock hits its previous peak and then sell? I think the most difficult thing about buying and selling shares is the timing. I mean, I've been doing this for 20 years, and it's extremely difficult to call either the top or the bottom. I think more important than that, one needs to look at where you got in and make a decision as to what you're happy with, depending on the trend of where that stock is headed, and rather be guided by what one sees as the ultimate value in that particular share, rather than trying to predict where it is on a day-to-day basis based on historical performance of the share. There are a couple of questions here. There's one that says, how much of Alviva's business is the old hardware type and how much the new? Unfortunately, I don't have those figures on me right now, but I will come back to you on that. If you wouldn't mind just popping me an email from Hugh, Brian at Merchant Tech, just to remind me on that. I can come back to you quite quickly on that. Question, do we cover SaaS Fund? Unfortunately not. Okay, whilst we wait for maybe a couple more questions, I am going to remind you that our next webinar will be on the 25th of August, where we will be interviewing the CEO of Workforce Holdings, Ronnie Katz. They will have just put out their results a few days before that, and we'll be able to talk to them about the results as well as the prospects of what is happening out there, particularly in the area of labor broking, recruitment, and human resources training. So if you can go and have a look and register, that's on the 25th of August. Yeah, a couple of bits. Do we cover Hoskins and Master Draw? Not yet. We cover about 30 to 40 stocks. Typically, those are under-researched businesses. Our views on the Metrofile buyout. Yeah. Look, I think COVID obviously has had an impact. In this, all shares are bought and sold in a relative market, so the valuation will have come down relatively speaking. Metrofile's business, though, is I would imagine hugely defensive. It's mostly storage, and it's annuity kind of contract business. So their growth prospects, though, will be impacted by businesses cutting back, certain businesses going out of business, business activity lower. So I would definitely say that the valuation on the buyout will expect to see a revised offer, because it's definitely not the same prospects that were there pre-buyout. And it's a question, it was a fairly decent offer at that time. And once again, it being a relative market one, we need to see, well, what is the offer if there is a revised offer in relative terms in today's market as well. Question about EOHs and ADI's debt levels. Are we worried about them? Yes, we are. We think that's what's bringing huge risks to the stocks. We really want to see from their results how well they are covering that debt with the actual cash coming into the business in these next set of results coming up in the next couple of months. Any update on Baldwin? No. We did interview them a few weeks ago, 4 or 5 weeks ago. We don't have an update on them yet, but we did put a report out. I think it was 3 or 4 weeks ago, that you can go on and have a look. Okay, I think that's a wrap. Guys, no more questions coming through. So I'd like to thank you very, very much for your attendance, and hope to chat to you again in a couple of weeks' time. Thanks very much. Bye.